Monthly update. I'm Nick Elder with Ironton Capital. I'm joined here by Lon Welsh, founder and chairman of Ironton Capital as well. How you doing, Lon?
I'm outstanding. Thanks for having me.
Thanks for being here. You're vital to the presentation, so I know everybody's excited to hear what you have to say. So everybody, there's a chat box on the right-hand side. Feel free to send your questions as they come. For those that are new to this presentation, as the questions come in, we always work to address them as we go on. And we usually have a lot of great questions. So please do not be shy to add in any of your thoughts, comments, and questions that you want answered. We have a lot to go through. If before anybody asks, I will say ahead of time, we will be sending out a recording of the presentation. I believe a copy of the presentation will go out as well. If you don't receive anything, you can email me, nick@irontoncapital.com, and I'll put that in the chat box, and I'd be happy to get that over to you. So that being said, let's get started. So just a quick disclaimer here from our attorney. So this document, this page that you're seeing here, this is a legal disclaimer for a presentation. So confidentiality piece of this. So the information here is confidential and only intended for potential investors for evaluation purposes. Now, this is not an offering an investment opportunity. We are presenting to you all the real estate trends domestically and nationally. But you may see some things at the end that highlight an overview of our investments. So please be aware that this is not an offering of investment opportunity. Any investment does involve a degree of risk. You may see some forward-looking statements when you get to that part of the presentation that says project, should, expect. Please just understand that those are all forward-looking statements. So that being said, Lon, I think I'm going to turn it over to you. And why don't you go ahead and introduce the yourself and the rest of the Ironton Capital investment team here.
Yeah, thanks for coming on here tonight and spending an evening with us. The three guys on the investment team are myself, Brent Geyer, and Richard Landry, and we're responsible for picking the investments that go into the different funds. And I do a lot of the research just on the general economy and develop the point of view of the firm about where we think the best investment opportunities are. So, this pile of research we're going to go through, this is a huge input to our selection process of what to buy and why we buy it. So you're getting all the same information to work with that we've got. So many of you are realtors and you want to have some summary points for talking to your clients. So I always like to start off with this. So the good news is that at least in the Denver, Colorado market, and this would be true for most of the Front Range of Colorado, generally speaking, this would apply to the entire nation. There may be some markets across the country that are slightly different, but I think this will be broadly correct for you outside of Colorado. Prices were up slightly in 23 and 24. What we saw is that home prices were up a little more. Condos and attached homes were down a little bit. Buyers in surveys are finally saying they're more likely to say, I want to buy. So it's good to see that the initial consumer intention to try to transact seems to be a little stronger now than say 12 months ago. And along with that, more sellers are agreeing this is a good time to sell. So even though you might have a really great rate locked in at 3%, and the idea of buying something new and paying 7% is sort of unappealing, there's a lot of life circumstances that drive people to do a transaction. They want to be closer to a preferred school, closer to an ailing parent, closer to a new job they just got promoted into. They need a bigger house. They don't want to fight with a remodel. All these traditional drivers are still at play in hundreds of millions of American families. And there's only so long that you can put up with an inconvenience. Like if your new job is an extra 40-minute commute each way, sooner or later, the idea of getting a new house and even paying the higher interest rate, yep, I guess it's time for us to do that. And we're seeing this accumulation of buyer and seller sentiment accumulate, which should eventually lead to more transactions, even without reductions in the mortgage rates. We are seeing a little bit more inventory, so it's a little bit less of a seller's market. So the buyers have a little more negotiation power and more to choose from. On a composite basis in a large city like Denver, you're going to find across 450 different neighborhoods, there are actually some buyer markets in some of these neighborhoods. Not too many, but some, where the buyers are really at a strong advantage. And if you are thinking about being a buyer and need to know where those are at, you can contact us. I can get you the map with a detailed drill down on a neighborhood by neighborhood basis of the supply and demand balance. And that's something that we're always extremely interested in ourselves. Rates have improved from 8% where they were at the apex. Now they're in the sevens. Certainly nothing to write home about, but they're a little bit better. I don't think rates are going to get a lot better. So you keep hearing about these optimists at the National Association of Realtors, the Mortgage Banker Association saying, rates are going to get cheaper over time. Frankly, I don't see it. I think that the expectation of the bond market right now is that this new administration is probably going to pass a tax reduction bill, so there'll be less revenue coming in, but they won't be able to cut the spending as fast. So as a result, deficits are likely, and the deficits are high right now. They're at record highs almost. The deficits are likely to increase. That means a lot more government borrowing. There's only so much capacity in the market to absorb all of these debt bonds, whether they're from the US government, Europe, Japan, China, or our mortgage bonds that we have to sell in order to provide mortgages to buyers. So since there's sort of a glut of new debt that's projected to come to the market, everybody's rate has to go up to entice the buyers of these bonds to want to take more than they ordinarily would. So the biggest thing that could happen to help us see the 10-year treasury come down, which would influence the mortgage rates to come down, is if Washington either is modest in their tax cuts or they're more aggressive in their spending reductions, either driver, which would result in deficits not increasing, you would see the rates come down pretty materially once you see a clear direction one way or the other. So stay tuned. I think we're going to have a lot more clarity on this in the next 3 months, and then it'll be a lot easier to do some forecasting. But right now, man, the crystal ball is about as cloudy as it ever gets. So what's going to happen to prices? I think you're going to see that volume on homes is going to be up and the volume on condos is going to continue to be soft. The condos tend to be on average about 180,000 less expensive than the homes, and they're more first-time buyer friendly for that. First-time buyers are really struggling to amass both the down payment as well as qualify for the high payment with these high rates, as well as the fact that insurance and HOA payments have also gone up quite a bit recently. I don't think you're going to see a huge turnaround in condo volume probably this year. It's going to be a soft year. Homes will probably do okay. From a pricing standpoint, I think it's going to be a continuation of what we've seen over the last 3 to 9 months, where home prices are going up a little bit, not quite as fast as inflation, but close, and condos are declining a little bit. So that's probably going to be the trend for the entire year, but I think certainly for the first quarter. Nick, anything on that you want to add in? I know it's a lot of blurbage for just a couple bullet points.
One common phrase I think we heard a lot last year, it's not as relevant in residential, but it's very relevant in commercial, is survive until 25. And I think why people said a lot of that is because they thought that rates were going to turn around completely in 25. And I don't think that's the case. So from a commercial standpoint, I think there's going to be a lot of muddy waters and some turbulent times for a lot of those people that were saying survive until 25. I don't know what the phrase is for 26, but it's something wait until 26. And whenever we hear that, I'll probably bring it into the trends calls.
I love it. That's fantastic. And for those of you guys who are more commercially focused versus residential, a lot of your loans from a local bank might be tied to the prime rate. And that's highly influenced by the Fed rate, which is always a very public thing. So if you were to rewind the headlines to about this time a year ago, the forecast anticipation was that in this year, we were going to have about 8 cuts of a quarter point each. I think the current sentiment is that it's going to be like maybe 2 cuts this year. Yeah. And that there's a possibility that it could just be flat. And the reason for that is that the inflation numbers recently have come in a little higher than anticipated. So it doesn't seem like the Fed has completely crushed the inflation monster. And if that's the case, it's going to be really hard for them to be excited about cutting rates. I mean, the last thing they want to do is, cut rates a little more, and then inflation pops up again, and they've really got to ratchet them up again. That would be kind of a replay of what happened in the 70s, and the Fed didn't look too good during that scenario.
Yeah.
So what does it mean? If you're a first-time buyer, I would tell you to buy now and then refinance down the road. Rates will eventually go down a little, but not a ton. But when the rates do go down, you're going to see the buyers are going to rush into the market a lot more rapidly than the sellers will. And that means that you'll see a lot less buyer power in the negotiation. So if you could buy now while there aren't a lot of buyers, you're going to have a much better time in the negotiation and the selection process.
Juan, would you say that advice resonates with both people looking for a house for themselves and investors looking for rental properties, or would you
Yes.
separate that advice accordingly?
Yeah, I would say that's definitely true as well. Like if you can find an investment that cash flows or it's got a value add opportunity that's within the skill set of what you like to do, I would buy it today. There's no reason to delay and just refinance it. I mean, the typical consumer stays in their house for 11 years. So if you've got 18 months of that at a higher rate and then you refinance to get to a lower rate for the next 9.5 years, overall, doing it now is probably the right answer. Similarly, a lot of investors, they tend to hold on to these things for quite a while.
We had a question that just came in. From
Yeah.
an investment standpoint, would you target condos more considering there's negative price pressures and more inventories to negotiate harder?
Yeah, Jorge, I would definitely be looking a lot more at condos than houses right now because, as always, like any point in time, there's going to be a small fraction of the sellers, no matter what the type of asset is, that are motivated that have got to transact, and there's just not that many people buying, particularly in the beat up properties that tend to be really good for landlords. So I think you could go in there and actually write some pretty aggressive offers, and I think that if you write 10 aggressive offers, someone's going to say, "Yeah, I'll take the beating. Let's just get this done." So yes,
Yeah.
absolutely. You might have to kiss some frogs to find the princess, but the princess is out there. So if you're a straight up buyer and the house you got to get rid of is at least average or above average, I would buy now. But it is really critical, and I can't underemphasize this, your house has got to be sharp when you bring it to the market. A lot of the buyers, especially the first time buyers, if that's what your product is, all of their cash is going to be going to the down payment. They're not going to have very much, if anything, left over. So if they've got to replace carpet, appliances, do an upgrade to a kitchen, they don't have the money to do it. There's really going to be a preference for them to buy a house that's just move-in ready, and they don't want to frig around with anything. So if your house isn't quite that perfect, if you could make it like that before you list it, it's going to really pay dividends to you and how fast you can transact and the amount of negotiation power it will grant you for having the nice product, and there's not a lot of it out there. If you're an owner occupant that you want to sell but you're not going to buy, frankly, this is not the time to do it. I would wait until the market improves a little bit. Generally speaking, the best time to list a house is in the spring. So as we're recording this on January 21st, like any time the next month would be like a pretty spectacular time normally. I'd probably wait just a little longer into the spring than normal because things are a little slow right now. If you're a trade-up buyer with a house that's below average, your house is going to be tough to sell. So unless you're willing to let it go for a soft price, and a lot of times you may be in a situation where maybe that's okay. Maybe you've got so much appreciation that you just don't care that much. But it's going to be tough to sell a house that's not parade ready in this soft market right now. We talked about investors. So I promise the other slides will go faster than this one. So some summaries of what we talked about. When will rates come down? They're not going to come down much. Our prices are going to come down. Condos will go down a little. Prices on homes will probably not. Can I find a new home? Yes. Inventories are up 30%. So yes, there's a lot more to choose from. Will the housing market pick up next year? So the experts are saying that unit counts are going to be up 15% this year. I will buy you a bottle of wine if that actually comes to fruition. So if anybody wants to take that bet, please let me know. I'm excited to take a bottle of wine from you. And market going to crash? No. So if you take a look at 2008 and 9, and we've got some slides to talk about this, the reason why the average home price in Denver dropped 25% in those years is that we had a gigantic number of foreclosures and we had a huge amount of inventory, like many, many times more homes on the market than we have today. And buyers were not excited about buying. So the supply demand balance was so out of whack. And a lot of the sellers were banks. They just had to dump their foreclosures. It didn't matter. They just had to get them off the books. That's what led to the negative price cycle last time. We don't have any of those factors this time. So I think it's extremely unlikely that we'll repeat that process. Consumer confidence. So historically, what you see is during a presidential election is 6 weeks of nonstop advertising saying the world is going to come to an end unless you vote for me. And that's all you hear all day long. And it's just really a buzzkill. So you typically will see that consumer confidence and consumer expectations of the economic conditions is really unfavorable because of this drumbeat of bad news all the time. So if you take a look on the right-hand side of this, like in middle of 2024 to fourth quarter of 2024, you see like it's a pretty low number compared to where it was even 6 months prior. And then immediately after the election, all that negative advertising goes away and consumer confidence spikes right afterwards. It's hard to get motivated to go buy a $600,000 house if you feel bummed out about your economic prospects. But fortunately, we have short memories in America. So once the ads go away, confidence bounces back up. So this is very helpful for us to have buyers and sellers more motivated to want to transact. Unfortunately, if you ask people, do you think that you are going to want to try to buy a house in the next year? It looks really bad right now. So what's driving this is that if you recall back about 12 weeks ago, there was like this 2 or 3 week moment in time where the 10-year treasury dropped a lot, the mortgage rates dropped a lot, and we saw a good little surgelet of buyers coming into the market. So when you take a look at the early part of fourth quarter there, where the spike got to like 6.25 on that rating, that's why it got so high, because the rates dropped for like a couple of weeks. And then the rates went back up to where they had been and actually went a little bit higher. And the expectation of I'm going to be able to buy a house next year fell. There's a very tight correlation between people's expectation, can I buy, and mortgage rates, which, you know, this just in like rocket science news, right? Okay, one nice thing is that there's an increase in the number of households that think they're going to move next year. So it's like 18%. That's probably pretty close to about the 15-year average of what percentage of households will move the next year. So about 1 out of 5. Unfortunately, it seems like the majority of those are probably going to be renters and not as many as normal on the buyer side. So that's a little bit unfortunate. So this is the consensus forecast from NAR, the National Association of Realtors, and the MBA, the Mortgage Banker Association. So all those loan officers out there putting together these mortgages for us. And they think that we're going to see an extra 500,000 homes sell this year. So I think that's baloney. I hope they're right. It'd be great for me, but I just don't see it going up that much. And we talked about most of these things. Buyer traffic is soft. Renters are struggling economically, and fewer renters.
Hey, Lon, going back 2 slides, buyers at new homes. I wanted to see the headline there. Buyer traffic at new homes is soft. I'm curious on this because, you know, one of the things you were just talking about a couple slides ago is that if you have a house that's beat up and is not parade ready, it'd be very difficult to sell that house in a timely fashion, or maybe even to sell it in general. So why do you think that the traffic is soft at new homes that theoretically we have very minimal maintenance, you know, in the first 5 years? So something that is completely move-in ready. Oftentimes you can go to these new homes, assuming these are, you know, builder type homes, or these, you know, it's a ground up that where they can offer a lot of maybe some, you know, lender incentives.
Oh yeah.
Why do you think the traffic is soft even at new homes? Is it primarily due to the interest rates, or do you think it's maybe some other factor?
Yeah, I think it's all interest rates. You know, most consumers really love a new home, and when you go to visit a new home community, they've always got 2 or 3 models that they've staged like a Disneyland castle, and they're just like beautiful to walk through. It's hard not to fall in love and say, man, maybe I should buy this. I mean, they know how to package the product really well. It's really just a function of the interest rates. It's slowing us down.
Yeah, that makes sense.
So this chart's really important for us from an investor standpoint, is that renter surveys show that fewer think they're going to be able to buy in the future. And that's because a lot of the people who are younger have more student loan debt than normal. Cars are more expensive than they used to be. The rate of interest on your car loan is a lot higher than it was. We have a lot of people spending a lot more on their credit cards now at much higher rates. Just they're getting kind of nibbled to death in every possible debt category. And then the things they're spending on, like eggs, milk, bread, gas, are all a lot more expensive than they were, say, 5 years ago. It's very hard to save it up a down payment. So the normal migration rate that we would see from people getting out of college, getting married, having a first kid, buying a house, that's all getting slowed down a lot. So that means the number of households in the rental bucket is really growing rapidly. So for us as landlords, it's all fantastic news. Credit card payments are really high. So if you're a realtor talking to a first-time buyer and they're bummed out for all these things we talked about, this is a slide I would show to them. So the Federal Reserve does this great study every couple of years to assess the net worth of a typical household that owns a home versus rents. And you can see the magnitude is at an all-time high. It's 380,000 more of net worth if you own your home. So I would share that with your first-time buyer, saying, look, I know it's really not exciting paying 7% for your mortgage. I know you're going to get a much less nice house than you were kind of dreaming about, but it's so good for you financially to own your place versus rent in the long haul. It's just worth biting the bullet and doing it. And most Americans, if you ask them what's the best long-term investment, the majority pick real estate, way above the stock market or gold or anything else. Okay, consumer confidence. Are prices going to drop? The quick answer is no, they're not. So let me give you just some historical context here. This chart shows you the average appreciation by state. I think this is from 1991. Yes, current. So the three states with the most appreciation are Montana, Utah, and Colorado. So our average price, if you paid 100 grand for a house in 1991, which isn't too far off what it was, it'd be worth $570,000 today. It's just a stunning investment. And even the worst states, Illinois, New York, California, still did pretty well. The overall average for the country was about 300%. So if you have someone who's thinking about buying their first house and they're worried about, is this a good investment? So 36% of the people say real estate's the best investment. So that means 2/3 of the people picked something else. This chart could help them realize, well, maybe real estate's a better investment than I realized. They may not have that fact like you do. So I wanted to show you, this is a new chart for those of you guys who've been on this before. The home prices in Colorado versus the average from 1991 to current. This just shows you how Colorado has outperformed the overall US. And then what I did for you here on the right-hand side is I said, let's pretend that it's 1991 and you've got $25,000 and you're going to go buy a typical house in Colorado for 100 grand. You're going to put 25 grand down and you're going to borrow the other 75,000. How would your investment of that $25,000 down payment perform over time? And you can see that your $25,000 down payment would be worth a little over $600,000 today. Absolutely stunning. What if instead you would have put the money into the stock market? Well, your 25 grand would have grown to about 270,000. Very respectable, but you'd have twice as much equity from the first-time buyer house than you would have putting the money into the stock market and staying as a renter. So again, if you've got a first-time buyer that's kind of struggling to get over that chasm, well, why should I do this now? I think this can be a very persuasive chart to help people understand why it's so.
One other thing I'd love to point on that one, if we think about that, Lon, right, from a volume of actual dollar equity growth, like 5% on a 5% growth on a $50,000 stock portfolio is much less than 5% growth on a $700,000 property, right? So, that's the thing that real estate that we all understand here on this call. That's one of the things that real estate has is, you're getting the appreciation, the valuation of the house, right? And you're kind of getting this nice forced savings bank from paying down your loan every single month. So, I think that demonstrates why this chart also looks like this. You're just getting the volume of actual dollar amount of growth is much larger in real estate than it really is in stocks.
Yeah, it's really hard to go wrong with real estate. If you're in the long haul, there's no period of time where it wasn't the correct answer. Okay, so if you ask all the experts what's going to happen to home prices, and I should say property prices, this would be a blended average of homes and condos both. The consensus of all the economists is 3% appreciation this year. And you can see, the AEI Housing Center and Wells Fargo are at the top of the list, about 5% growth, and Morgan Stanley is the most negative at -2%. I would say you'd probably be somewhere in the 2 to 3% range. So I think I could agree with what all these economists say. Okay, affordability we've talked about. So we're probably going to see a little less home price appreciation over the next 5 years than we've seen historically. And that's because I don't expect that mortgage rates are going to decline a whole lot. And people are really stretched to be able to afford to buy their first place today. And this chart really kind of illustrates that. If you take a look at the red line from 1975 to current, this shows you how household income has been growing over time. And if you look at the blue line for the home prices, you can see it's grown a little faster. So it's gotten a little bit increasingly more difficult for people to afford to buy a house because their incomes haven't kept pace. That plus the higher mortgage rates, plus the higher insurance, plus the higher property taxes are all headwinds that are hurting people's ability to buy their first house. So again, wearing our landlord hat, it means we're going to have a broader pool of renters for a really long period of time. So we can build more apartment units, and there's going to be a ready audience of people eager to rent them from us.
We got a couple of questions here. What would single family home price growth be when you factor out condo/townhome for 2025?
Well, that's a great question. You know, if we said that we thought the overall of all the market was going to go up 2%, I'd say if your houses went up, say 3%, and if your condos were flat, that would probably be just about right nationwide. I think the condos in Denver won't do that well. I think the condos in Denver will be down a couple percentage points this year. Nothing severe, but they'll be down a little bit. It's a bummer of a time to sell a condo right now.
Yeah.
I mean, it's not 1980, it's not 2007 or 2008. That was really awful. Okay. There's a lot of pent-up demand. I don't want to go through these slides though. So quickly, will there be a foreclosure boom? Some of you have told me that you're getting this objection from your clients. So I just want to quickly show you why that's not going to be the case. So this shows you delinquencies. So you've got from 2003 to current. So the apex of the home crisis was 2007, 8, and 9, and you can see about 9% of all the mortgages in America were delinquent during the crisis back in 2008, and currently we're at like 0.5%. So the vast majority of people, if they have a mortgage, their mortgage is at like 3 or 4%. A sizable number of people have no mortgage at all. So there's very, very few people that have got a mortgage rate that's say above 6%. And those are probably people who bought relatively recently. They're the most likely to be candidates to be behind on their loan. But anybody who's been in their house for a little while, like their mortgage rate is so cheap, they're not going to have any trouble making their payments. If they did, they've got lots and lots of equity. So this chart on the left shows you the composite equity value of all the homes in America is about $32 trillion. And the composite of all those mortgages is about $13 trillion. So we've got more equity in our homes across America now than at any point in American history by a huge margin. So the majority of households, if they get into trouble, they can afford to hire a realtor, sell the house, walk away with $250,000 in cash, and get on to the next phase of their life. Amazingly, 39% of homes do not have a mortgage. Isn't that incredible? There's not a lot of leverage out there right now. Okay, our mortgage rate is going to go up or down. So let's talk about that for a couple minutes. The chart on the left shows you what the mortgage rate has been recently. So you can see earlier we were talking about how about 12 weeks ago, mortgages went down really low for a couple of weeks. It's sort of like this Goldilocks period. We wrote a whole bunch of contracts, and then they've since returned up quite a bit. So the chart on the right just shows you the spread between the 10-year treasury and a typical mortgage. So to understand how mortgage rates work, you take the 10-year treasury. So when the US government's borrowing money for a 10-year period, that's the 10-year treasury. You take that plus a risk premium, which is the chart here on the lower right. Currently it's just under 3%. Those two numbers added together are what it costs to borrow on your mortgage. So if you take a look at that chart on the right, you can see this risk premium is a lot higher than normal. Usually it's a little under 2%, and currently it's almost at 3%. So it's about 1% higher than normal. So if the risk premium were just to go back to the historical average, the typical mortgage rate would drop by 1%. So why is it so high? Well, there's a lot of concern that the mortgage rates are like 7% right now. And as soon as the rates drop, everyone's going to refinance. And then if I bought this mortgage from you at 7% and it refinances, and I get paid back too quickly, I'm just going to make a new mortgage, but I was going to be at 5 instead of 7. It's a real big disappointment for me as an investor. Not a situation I want to try to get myself into. So to protect myself from that, I'm asking for a bigger risk premium than I historically would. If we all decide as a market that there's almost no chance of the mortgage rates going down, that means the chance of a refinance really starts to go away. That risk premium will start to come down. The way that would happen would be is the current administration passes a set of tax cuts that increases the deficit. And that means mortgage rates aren't going to go anywhere. If anything, they'll even drift up a little bit higher. And or if the efforts to reduce government spending fail, that would also drive up deficits. Either one of those two things would give the market a lot of longer term certainty that there's not a lot of refinance risk, and that could cause this risk premium to go down. So ironically, it could be possible that if you saw a big tax cut package, that actually mortgage rates could go down a little bit for that rationale. That would be like really spectacular. We'll see what happens with it.
Question from Randy. I think you meant, but now is a good time to buy a condo. What are the impact of the HOA fees on buying and selling condos right now?
That's a great question, Randy. So what you want to do is get a hold of the HOA budget for a community that you're interested in and just go through the line items that make up the HOA budget so you understand what's going in there. So when you do this, you're going to find that pretty much everything in the HOA budget is actually useful. There's very little fluff. A common misconception is that HOAs are a waste of money. And the reality is that really they're not. So usually what a large component of the HOA will be is water and sewer, because that's usually not independently metered for each unit. Those are things you'd have to pay for if you had a house. Usually you've got a tennis court and a clubhouse and a swimming pool that you have to do maintenance on. Someone's got to shovel all the snow. These are all things you'd have to pay for otherwise, right? It's not like there's something special. And then there'll usually be maintenance reserves getting set aside each year to change out the elevators, repair the roof, paint the outside, take care of the landscaping, maintain the sprinkler systems, take care of the boiler if it's one boiler for the whole unit. All things that you'd be responsible for as a homeowner. So understand all those items, and most of the things I just mentioned are going up at a relatively normal rate of inflation, and I think we could probably project over the next 5 years they'll continue to go up at a normal rate of inflation. The problem areas recently have been property taxes, and usually that's assigned directly to the unit. It's not in the HOA. You can check that to make sure that's the case. And then the large insurance policy for all the exterior stuff on the complex is usually embedded in the HOA. The owner is required to insure what's inside the condo, and that's usually really, really cheap. So the biggest driver on the HOA inflation recently has been the growth in insurance. So if you've got a skinny HOA, and by that I mean you don't have a clubhouse and a pool and all the amenity package, the insurance as a percentage of the overall HOA budget will be larger, and you're probably at more risk for that HOA to go up faster than inflation over the next couple of years. If on the other hand, the insurance is a relatively tiny part of the overall HOA, that's probably the highest inflation item on your budget. Maybe you'd be in the opposite situation. So that'd be one thing I would take a look at. But honestly, like we were talking about with Jorge a few minutes ago, you can negotiate so hard on condos right now that you could probably get such a good price that you could absorb some of that noise and still be pretty happy on a 5-year hold. I think it's certainly worthwhile to go out there and take a look. Great question. All right. So we talked about the 10-year, and this is what economists are projecting for mortgage rate declines over the next year. I'm not as bullish as they are. I think rates are going to be flat. They could go up a little bit. As soon as we have direction from Washington about what they're going to do for tax cuts and deficit sizes, that's going to give us a lot of input on this. It's impossible to sort of project right now. So this chart's a little bit out of date. The current mortgage rate's just a hair over 7%. So that green line on the bottom should be a little bit higher than it is. Something I want to talk about here is that historically speaking, over the last 50 years, the average mortgage rate in America has been 7.7%, and currently we're at 7.01 or something like that. So while our mortgage rates feel high relative just to the immediate past, especially 2021 when they were like 3%, historically speaking, they're still pretty good. We, as an industry, sold millions and millions and millions of homes during the 70s and the 80s when rates were like at 10% or higher. So once consumer expectations ease up and they acclimatize to the idea of having higher mortgage rates is okay, the number of transactions will eventually go up. It's just going to be sort of a slow and gradual process. Incredibly, 1 out of 3 home purchases are made with all cash. Absolutely unbelievable. So here's the one thought I think is really great to share with your clients. So in 1971, the average mortgage rate was 7.3%, pretty close to what it is right now. And if you had a buyer in 1971 that said, I'm going to wait till the rates go down, you would have waited 22 years before it happened. But meanwhile, the value of real estate during that period quadrupled. So go
Wow.
on.
Hey, Lon, are you concerned about owners getting financing for condo townhomes with high insurance deductibles on the buildings?
That's a fabulous question. So your lender is going to ask for a copy of the policy. And if the deductible is, I don't know the ratio. I think if it's more than 10% of the value of the complex, they won't give you a mortgage. So there's only 5% in Torre says, great. So someone here knew the facts. That's awesome. So if you're too aggressive in cutting back on the quality of your insurance, you won't be able to have anybody get a mortgage to buy a new property there. So the HOA will get a swift kick in the ass and say, oh gosh, we got to get a better insurance policy than that. So there's a safeguard to prevent that from happening. Good question. Here's some commercial rates, if that's of interest to you. They've been pretty good lately. So we talked about the rates increase, in fact, impacting the market a lot last time. So I think I'm going to skip that this time around. So let's talk a little bit about long and short-term rentals. So if you take a look at the composite of the rental market, about a third of the market is consisted of guys like us on this call that have like a rental unit. And then a lot of us on this call might be in that 12% bucket of people who have like a 2-unit or a quad. It's amazing that collectively is half of the overall rental industry. So those of us on the call, although we may only have like 10 units in our portfolio, we're a very important part of the overall rental solution for the economy. So rents are growing faster than income in most cities. And I highlighted Denver here for you, just showing the growth in household rent of the renters versus the growth in rents over that same time period. So it's been a really good opportunity over the last 5 years for landlords to take a greater share of cash from renters. So the renters in America are a little bit stretched if you take a look at how much they spend in rent relative to their income, but by no means are we an outlier relative to other industrialized countries. We're not too far off the median, actually. So if you take a look at the global trends, it suggests that is there room to raise the rents further than we have already? Well, yes, Sweden, France, Denmark, Austria, Germany, they're all spending quite a lot more as a percentage of their income than we are here. So you'll see headlines if you go back about, well, it's not fair that the average rent went up by 27% in Denver over the last couple of years, while the average income only went up 22%. Well, I don't know if it's fair or not. It's just a fact. That's just how things are. But with us spending 22% of, is it 22, 27? In Denver, the number is 27%, and in Germany, it's 50%. So people have a pretty high standard of living in Germany as well, and they still somehow pay their rent. So I wouldn't be discouraged about the potential of the industry to increase rents further.
What are the best financing options for an HOA with no convention or FHA?
Yeah, so there's a bunch of things that could disqualify a condo from being eligible for favorable financing. Basically what that means is that if you follow all these different rules and qualify, Fannie Mae or Freddie Mac will issue you a mortgage to buy. And those will usually be on more favorable terms, either a lower down payment, a more favorable interest rate, or maybe both. So things that screw it up are if your insurance deductibles are too high, which we talked about, if the percentage of landlords in the complex is too high, it's a higher risk statistically, historically, than if the majority of the condo units are owned by owner occupants. And there's 2 or 3 other things, about reserves and other factors. So if you trip over any one of these underwriting tripwires, your complex may not be eligible for attractive financing terms, which means it pretty much has to get sold to an investor like Tom. And Tom, what that means is that you'll probably have to go to a local bank like Bank of Colorado. And since the buyer pool is much smaller for this complex, you can negotiate a lot harder and get a much better deal than if you had to compete with all these first-time buyers. So usually what happens is that these units will trade at a 10 or 20% discount to a comparable property in a similar location with similar amenities that was eligible for the typical financing that you'd expect that a first-time buyer could get. So if you could buy the same 2-bedroom, 2-bath for like 10 or 15% less, it's going to rent for about the same if the amenity package is the same. That should be an extra cash flow for you. The only thing that you want to coach the buyer, investor buyer on in this situation is that unless you can fix this problem during the time that you own the property, when you sell, you're also going to sell at a 15% discount. So it isn't like it's a huge advantage from your overall wealth creation. You're going to buy at a discount, you're going to sell at a discount. But the cash flow you earn during the holding period should be superior to the option where you have to compete with the first-time buyers. Does that make sense? Most of my rentals I have that are condos are all exactly as you described. So there are headwinds in Colorado. There were 9 new laws in 2023, all in favor of the tenant that were aggravation to the landlord. And there was 4 more laws in 2024 that just sort of piled on, making it more difficult. There's a number of proposals for new legislation this year that are all pro-tenant as well. So what this means is that if you take a look at this chart, many of us that own the 1 units in particular are going to sell. And when we sell, we're probably not likely to sell them to another investor. If it's a community where you can get first-time buyer financing, it's most likely that the person who buys from us will be a first-time buyer. So what this means is that the size of this entire rectangle of the entire community of all the rental units, let's say in Denver, is going to get a little bit smaller every single month as people on this call decide, I'm sick of these new laws, I'm going to sell my units. There's going to be less available inventory. So what that means is some of you guys on the call are going to say, although these new laws are a pain, I'm going to put up with it. And the reward for you will be is less competition from me if I sell mine. So you'll have more pricing power and you can raise your rents faster. It has to work that way because if the market's more difficult, you have to be paid more for the headache factor of it. And that's exactly what's going to happen. Okay, there's a lot of enthusiasm for short-term rentals. So what is happening on a small scale across America is that there's financially qualified people who've got a house and they've got a great loan at 3% and they get a new job and they've got to move from Denver to Houston. And they can afford to buy a house in Houston without having to sell their house in Denver. What do I do with my house in Denver? So about half of them are putting it into the long-term rental pool and the other half are putting it into the short-term rental pool. So we've seen this is a source of new inventory. It hasn't been as big as we thought it was going to be on the long-term side. So I don't think it's screwed up the supply-demand economics. But on the short-term side, it's really been material. So what's happened is we've had, I think I've got a chart that here that'll show this. Yeah, here we go. So if you take a look at the top line of this chart, this is the number of available short-term rental listings. This will be Airbnb, Airbnb and VRBO. So in 2020, at the start of COVID, there was 1.1 million, and right now there's 1.65 million. So we've seen a 60% increase in the available inventory of short-term rentals in a 4-year period. And this lock-in effect of having cheap mortgage rates, I think it's the primary driver of why these 600,000 units landed in the market. So demand for short-term rentals has also grown during this period, but it's not grown as rapidly. So if you take at the fourth look at the fourth line on here, occupancy has gone from 57% to 55%. So it's eroded a little bit. So because there's more competition, and since the supply has grown faster than the demand, there's less pricing power on the part of the owners. And you can see this in the ADR. So ADR is average daily rate. And that's just there's a math formula of what's the average rate getting charged times the number of nights per year I'm able to rent my unit out, adjusted for how many nights was the unit available. So you don't need to worry about all the math on this. But the net result of all this is that the ADR, available average daily rate, and the RevPAR, revenue per available room, has been relatively soft. The expectation over the next couple of years is that the number of units is going to continue to grow, but not as fast of a pace as it has. And it appears as though the demand drivers for short-term rentals are going to continue to be relatively healthy. So if you take a look at occupancy, I think this is the easiest thing for us all to relate to on the fourth line. You can see this year we're at 55%, and it's by 2026 it should improve a little bit to 56. So it's not going to get to as good as it was pre-COVID, where it was 57, but we're going to heal about half of what was taken away from us over the next 2 years. So what does that mean for you? If you have short-term rentals, you are probably a little less profitable this year than you were a couple of years ago due to the increase in competition. And that's probably going to improve for you a little bit over the next 2 years. But it's unlikely that you will get to the wonderful performance that you had pre-COVID. That's the average of all of the short-term market. Individual results will vary a lot. So in some areas, there was a lot of new supply that came on. Say you're like in Centennial for single family homes. For whatever reason, there was a lot more than you would have expected that came online there, but the demand didn't change. So in that local submarket, it's been more punishing to the owners. There's other markets where it's been the opposite. Like if you're in downtown Golden, for example, supply is locked, demand has increased, occupancy has gone up a lot, and we've been able to raise our rates a lot. So ironically, I have 2 Airbnbs that are maybe 8 miles as the crow flies away from each other with entirely different supply demand dynamic changes over the last couple of years. So you'll want to evaluate this information not at the global level that I just presented it in, but at your local micro market. And if you have questions on that, call me and I'll try to help you think through all that. You guys have any questions that popped up on that?
Question from Randy. Isn't there a risk that the condo can be, back to the condo, so isn't there a risk that the condo can be warrantable? Then there's an increase in the number of investor properties that decrease the value of your property. Is there a solution?
Yeah, so what can happen is, I don't remember the exact ratio. Somebody on the call probably remembers, but I think it's like if more than 20% of the units are non-owner occupied, then it no longer will qualify for like really attractive first-time buyer financing. So if you've got an alert HOA where the ratio is at 15%, what they'll do is they'll pass a bylaw saying that we're going to cap the number of rental units in our community at this number that we're at today, and we're not going to allow any further ones until a landlord sells a unit, and then it would be okay for another landlord to buy it, but we're not going to allow the number of landlords in composite to increase so that we don't trip over that. And that's legal for them to do, and that's typically how they manage around it. You need to have a community that's paying attention. Sometimes they're good on their management, sometimes they're terrible. There's the whole range.
And then Enrico, yes, in Denver, you can only short-term rent your primary residence, correct?
In Denver County, that's right. So what you could do is, like, if you've got a big house, you could short-term rental out some of the rooms. There's rules about how many days a year you've got to be there. You can look all that up, but Denver County makes it really, really difficult. So the hypothesis that our enlightened city council, if I may pass a judgment, I hate to do that about our quality of our government, but is that if they limited the amount of, if they took away the incentives for someone to buy a unit to use for Airbnb, it would make more units available for owner occupants. So that was the same theory that New York City had about a year and a half ago when they outlawed a lot of Manhattan Airbnbs. And what the studies found after the fact is that the number of owner occupants didn't really improve at all. It actually didn't make any difference. let me illustrate that. So like if you're in Summit County, so Summit County, if you're not familiar, is Breckenridge, Keystone, Copper Mountain, Dillon, and I think it's Frisco. Those 5 cities are mostly Summit County. Up until recently, most of Summit County allowed Airbnbs, and recently they really restricted it a lot. And what the city councils there hadn't thought through is that there's a lot of people who might be like a school teacher that on their income, they can't afford to buy a house in Frisco. But what they could do is they could afford to buy a house if they put 2 of their units on Airbnb, and that supplemented them enough on their mortgage payment that they could afford to qualify and not live 40 miles away and have to drive 40 miles each way to be able to teach a class at an elementary school. Now that school teacher can't do that anymore, even though they've already bought the house and they've already got the mortgage signed up. So now they're like really in a vice. So they've either got to sell or they're going to default on the mortgage. They just don't have enough revenue coming in to be able to make the mortgage payment. And unfortunately, none of the cities have thought through all this. So that's a frustration for another day, probably.
Lon, do you foresee, with Denver County rules around short-term rentals, do you foresee that extending into other counties in the Denver metro area, such as Jefferson County,
Yeah,
Adams County?
great question. Each municipality's got a really different set of rules. So I've got a couple in Centennial, and it's actually come up in front of Centennial a couple times, like, should we adjust this or not? And they took a different approach where they published a set of guidelines that were all sort of common sense, that if you're going to have a short-term rental in Centennial, you have to have carbon monoxide detectors, you have to have fire extinguishers, you have to post it somewhere. Like if there's an emergency, who do you call 24 hours a day to come fix the problem? It was all stuff that sort of made sense, and they decided as a community they wanted to have them in there. So I still have them in Centennial. Some parts of Golden are zoned for enabling Airbnbs, and that's where I've got a 10 unit there that I use for that. And then other parts of Golden are not. So I had a duplex in Golden. It was a cash machine, unbelievable. And they changed the rules there, and I had to sell it because it wasn't allowed anymore. So it was really a bummer. But what it did is, like, for those of us who are still left over, who did have the license, like, our rates went up and our occupancy went up, and it was fabulous for the survivors. Okay. So I've got 5 minutes left. So much stuff we could talk about if only there was time. I think I'm just going to stop here and let's just do other Q&A for the last 5 minutes left.
Yep. Sounds good. Everybody send over any questions that you might have. We got 7 minutes here, so happy to answer them as they come through.
Fun to have some new slides to talk about. Wow, no questions.
Looks like that may be it.
Maybe it is.
Yep.
All right. Well, thanks, guys.
Tom's asking, will Fannie Mae change the rules on insurance deductibles for HOAs?
I haven't seen anything in the news about that, and I can't imagine they're going to loosen the guidelines because it certainly would create a lot more risk for the people insuring all these mortgages. So I wouldn't expect a lot of change on that. It's a good question, though.
Lon, on the insurance side of things, we've obviously seen really unprecedented insurance premium increases, at least the last couple of years. I think it's somewhat leveled out. But do you suspect that, these California fires will have a residual impact across the rest of the nation from an insurance standpoint? Yep. I figured.
Yeah, there's an article about that in the Wall Street Journal a couple of weeks ago. Some states have got really strict limitations on how much insurance rates can adjust up each year, and some states just don't care that much. And what they've shown statistically is, like, in years where there's unusually large losses, either hurricane losses or wildfires or hailstorms or whatever, the rates go up across the whole U.S. when there's larger losses. So absolutely, it'll impact everybody. And the 2 hurricanes we had this year in Florida weren't any joke either. So we've got actually 3 pretty good size problems all within 4 months.
Now it's snowing there, so they can't seem to figure what's going on. Do you think Denver will see large-scale relocations from LA?
The quick answer to that is no, and I can show you.
One of the things Gail mentioned here as well, and actually I've been seeing this quite a bit, Insurance companies do not want to insure condo communities that are more than 30 years old, so they put extreme conditions for consideration. That's probably becoming more and more common. I know, I mean, we've got a building from 1981 that was incredibly difficult to insure. And so I think that might be a growing trend. I think insurers do not want to insure these buildings that were, that we bought in the 1970s, 1980s. Like, those are becoming very old buildings now. And it seems like insurance companies are very reluctant to insure those properties.
So we didn't go through this chart. This is a new chart. I don't think I've ever talked about on this class before, but it shows where people move. So if you take in the upper left, this is people who are leaving California. Where do they go? And the answer is the vast majority of them didn't go too overly far. They went over the border to Nevada, was the most dominant, and Arizona was probably the next most dominant. Where you can really illustrate this well is Illinois, another really high tax state with a lot of regulations like California. And you see the vast majority of people who left just went over the borders to Iowa or Wisconsin or Missouri, but they didn't go too far. So in all these cases, if you take a look at where Colorado's at, you can see Colorado isn't really a very big beneficiary from most of the California outbound traffic. Nevada and Arizona would be the primaries, probably Texas would be next. For Florida, again, not a whole lot of traffic to Colorado from Florida. It's primarily Georgia and Alabama. And we talked about Illinois, New York, it's all on the East Coast. Texas is probably our best beneficiary. People leaving Texas are New Mexico and Oklahoma and Louisiana, but we're right behind them in Colorado, which is nice. And then Virginia, not much of a help to us. So not as much as you might think.
Tom's asking a question here that might already be happening likely in Florida with their condo market. What is the ultimate fate for an HOA community that is uninsurable?
I think that there's a state-backed insurance company of last resort. So their rates are unfavorable, and they're probably like customer service of zero. But there's always somebody who will step in and do it. And ultimately, that's probably going to have to happen more and more often.
Yeah.
I've got a place on the ocean in Florida, and our insurance is more than doubled in the time I've had it there. But I'm still amazed that the price of the insurance relative to what it would cost to rebuild is like 1% of the value. So what the insurance company is telling me is that they think that there's a 1 out of 100% or 1% chance that in any given year, the place will be wiped out and have to be completely rebuilt. I think the odds are a lot higher than that. So to me, the insurance looks like a really, really good deal, even though it's more expensive than it used to be. So I guess it all depends how you look at it. Great question.
Well, that's all the questions that we have. I guess we got another minute or two, but if anybody has questions when we leave this presentation and then comes up tomorrow, feel free to reach out to us. We're always available.
Well, thanks guys for making the time. I know that I'm the last thing between you and Miller time, so I don't want to prevent you from getting to happy hour. And thanks for joining us, and we'll see you next month.
Awesome. See you guys.
Thank you.